Alright folks, take two then I guess. I recorded the whole thing without the sound on. Let's do it again. I got myself a little thingy-mabob here to play with. I don't know how much use it'll be. I'm thinking I'll probably end up never using it, but I don't know how difficult it is for you guys to follow what I'm pointing at on the screen. So I thought I'd give this a little go. So if I want to highlight something, I can just kind of underline it like that, I guess. Is that a bit thick? It's a bit annoying. I'd really like to be able to just draw a rectangle. So like if I went like that, I'd like it to just draw a rectangle like that. But I can't seem to find anything that does that. This doesn't seem to have the option. Anyway, enough of that. Let's get on with the show, shall we? So yeah, this week I've done pretty badly compared to the life strategy funds. As you can see there, I'm pretty much flat. All three of those are done way better than me. I had a look, and since the 6th of October, I'm already about 4% behind Life Strategy 100. Where's that performance come from then? There's the numbers. What's done well and what's done badly? So the small cap 600 has done pretty well again. So that's still on the election bounce. Brunner's come back a bit. I noticed that Brunner went to about 4 or 5% premium to NAV last week or the week before maybe, and then they announced a like issuing more shares. They announced that, so it's I think part of this is just an unwind of the premium to NAV. Property ones seem to have done pretty well, and then these two renewables have done badly. Anyway, you can see the numbers there yourself, and then I'll just show you the Fundsmith numbers as well for the record. There they are. Metler Toledo's done badly. And a pretty good week for the dividends. 300 and let's pointlessly use this, shall we? 375 for the week, which is pretty good. Mainly because of Murray International, and then Care REIT bumped it up quite a bit. And the usual small ones from the SCHD portfolio. And then the RNSs, we just had a few this week. Well, two of them were pretty much the same one. NESF, so NextEnergy Solar Fund, had their interim results. Well, we can see the key highlights are that the NAV went down. Well, if we go to the 3-month chart, this happened in September, so this should already be in the chart. Why isn't it in the chart? Why are you making a liar out of me? Because this is the 30th of September. This should be the end of September. NAV is now 97.8. So why doesn't that show in the chart? We've got here in November, it's going down, but that's because of the dividend. It's like they've applied the NAV from the 30th of September has been applied on the 21st of November in this chart, because that's when it's gone down to 97-ish. Although they've got the right information. 30th of September, 97.8p. Yeah, I think they've got an issue with the chart here by the looks of it. But yeah, I mean, as we can see from the chart over the full year, this is really just a continuation of the downward trend in the NAV for this fund, or the NAV per share. So yeah, it's I mean, later in the interim results, it goes through what has contributed to that NAV reduction. Yeah, so they talk about the capital recycling programme, but then they give a more detailed update on that here in the second RNS of the day. Basically, they've sold this site, Staunton, at a 21.5% premium. It does whiff a bit though to me, because the purchaser is called Next Power UK. Now, you might ask yourself, is that a coincidence that their name is Next and the name of our fund is called NextEnergy and that's called Next Power? They sound a bit similar, don't they? And it's not a coincidence. It's managed by the same people, NextEnergy Capital. But then, you know, apparently they've ticked all the boxes to make it an independently valued transaction, but I still wonder, you know, is it a 21% premium because they know this is by far their best asset and they've just sold it to their other fund? It makes me wonder whether I don't know, it doesn't sit well with me. That's the one they've sold in this period for 21%. And they've got other premiums here for the other ones they've sold. And then these two, they're also going to sell. And they're operational as well, yeah. Yeah, anyway, so yeah, just the usual stuff happening there. I mean, we go through where the NAVs come from. So we had an increase in NAV because I think I've decoded this little paragraph here. You can read it in your own time. It seems to just be saying our projected income is now 6 months sooner. Bit weird. Not quite. I don't know how all this stuff works, to be honest. But yeah, so offsetting the reductions coming later is that. So the bulk of the lowering of the NAV was power price forecasts going down a bit. They show a chart later. So that's where a lot of the reduction came. Obviously 5p of it came from paying the dividend, but that, you know, that's cash in our brokerage account, so that's not a bad thing for us. Project actuals. Because look, we've got income here of 45 million. So where is that in the NAV bridge? So as you can see, I invest in these things, but that doesn't mean I understand them. Here's their graph of the power price. The September. See the navy blue lines are the new projections for power prices, and you can see that they're coming down quicker than these June and March ones they've got here. This period here we have lower prices, so that's why they're projecting lower income for those periods. So I mean, it says here they've got a future pipeline possibility of 500 million, but I mean it takes money to build to actually create that pipeline, and they say that actually it could. I mean they're implying here that actually they could end up. They're not implying. They're actually saying they might just buy back shares instead because we're at a 29% discount, I think, to NAV. Yeah. It would be. I wonder how long it's going to be before this NAV stops declining. We'll have to wait and see. In the meantime, I'll just happily accept the dividend yield from it as it goes through its times. All right, and then there was also a update from REIT. So this one's at a similar discount to NextEnergy. It's about 29% discount almost. But the NAV for this one has just been cruising along really, not really increasing that much, but just kind of flattish, but on an upwards trajectory slightly. And I think, if I remember correctly, another small increase in the NAV per share. Although that's just per quarter though, isn't it? So actually it's kind of like a 2.4% over a year if they had that every quarter. Well, it'd be a bit more because of compounding, but you know, somewhere in that ballpark. So they've had 12 rent reviews in the quarter, averaging at 3.6% increases. It's pretty good. So they've put a few mil into refurbishments of 6 properties, and they've sold a couple for 4.5 million. They've bought a couple more, and they've disposed of a few. Yeah, you know, just not much to say really. They're just doing what a property REIT does really. You know, they're buying some, they're selling some, they've had some rent reviews. Not anything directly for me to care about, but I'll just let the dividend come in. Right, and then the last thing, because it was a quiet week, when I uploaded last week's video I got suggested one. When I was checking the video before it went live, and I got suggested a video. It reminded me of this thing that I've seen a few times over the years where people project dividends. Let me find the video. Right, so basically in this video, this fella, he's not the only one. I've seen many a video like this that makes the same mistake. Basically, he's talking about SCHD, about what it does. But then towards the end, where is it? Towards the end, he does a projection of. Here we go. Yeah, so he's doing a projection of investing $120 a week into SCHD. And then the projector, I don't know what software or spreadsheet he's using, but by the end of it, we get this projection over 30 years. I mean, they're all crazy, but here's the end results. We've got a 30-year projection there. But as you can see here, what they've done is put these inputs, 3.1% starting yield, which I think is probably what SCHD yields a couple of weeks ago. And then he's used the 5-year history of SCHD to put in the growth rates, basically. But we can see that the result here is that after 30 years, we've got this projection of dividend income. We've got there dividend income of 185,457. We've got here a portfolio value of 26,28,1 7.133. So what we've ended up with after 30 years is a yield of 7.05%. I mean, it doesn't take a genius to work out that that cannot be sustainable. Because what we've got here is we've got dividend yield of 3.41% to start with. But then what he's done is he's just put in the last 5 years worth of SCHD data, I think. It might be 10, not quite sure. But anyway, he's put in that the share price should grow by 8.89%. But then he's put in that the dividend should grow by 12% a year. So it's obvious that if the dividend grows by more than the share price grows, then that means the yield has to go higher. And that's exactly what's happened here. We've ended up with a yield of about 7% on this projection. Now, the thing is, the market would never price in a yield of 7% on something that grows the yield at 12%. 12%, because at a starting yield of 3%, 3% or 3.41, a 12% growth in that dividend per share doesn't sound that crazy, because the yield isn't like massively high to start with. But once it gets to 7%, the idea that the market would price in 7% yield, the share price, if we thought that the dividend per share was going to keep going up by 12% forever, the share price wouldn't stay that low. The share price would go higher and the yield would come lower. So that's one reason why these projections are just completely nonsensical. I had this spreadsheet a while back that I created, so I've just linked it here. It does all the calculations differently. Instead of doing it weekly like his spreadsheet probably does, I've just done it. I've simplified it. I've done it by like investing a lump sum every year instead of doing it gradually, and it just works out all the same numbers. So if we put in the same numbers as him, he's got 3.41 starting percent yield. We've got dividend growth of 12%, and he had the share price growing by 8.89%. And as you can see, even the total return in year one is 12.3%. That's how I've calculated it. So, I mean, how I've calculated it is it's the yield plus the share price growth, because that is your total return. You get paid 3.4%, and also the share price grows by 8.89%. That's just a simple way of working out the total return. I mean, in reality, the total return is slightly higher. This is a total return if the dividend was paid once a year, and it was 3.4% of the starting price. But, it's a bit oversimplified. So, because if you were paid quarterly, your first dividend would to work out the total return, your first dividend would buy more shares, and then those more shares would give you a higher dividend later. So, but this is just a simplified version to give a rough projection. So the total return is about 12.3% at the beginning. But because the share price grows slower than the dividend, that means that the yield has to go higher. And that's exactly what this column here is calculating. And so if the yield gets higher, that means that if we add that yield to the share price growth, which continues to be 8.89% throughout the whole projection, that means that the total return is 13.4% instead of 12.3% as it is at the start. So we get this just completely nonsensical projection where the total return goes higher and higher and higher every single year. So that's just unrealistic. I mean, it's unrealistic because of that, but it's also unrealistic because even that starting total return is too high. It's just recency bias of that's what's happened in the past few years. When you're projecting over 30 years, you've got to take into account long bear markets or long bad times in economies and stuff. Even if you reverse the numbers and go 8.89% and 12%, what happens here is you get a similar effect, but you get the reverse effect. You can see there that the yield goes lower and lower, which makes sense. Share price outgrows the dividend, the yield will get lower. So what that does is it makes the starting total return much higher, and then because the yield is getting lower, the total return goes lower and lower. Basically, what happens is if you projected to infinity years, it would tend towards 12% because the starting yield gets infinitely small. Either way, it's over optimistic because of the share price growth being 12% there. Either way, it's optimistic. But let's just forget the over optimism. Let's just do something that makes sense. The way mine is calculating it, the numbers are a bit different to his, but not massively different. He's got a few $100,000 more in the account value, or the portfolio value, and I've got a bit more projected annual dividends. But if we just look at my projection with his assumptions, it goes from 197 grand to, now if we want to keep his over optimism, we can do something like just doing an average of the two, because what we need to happen to make these sorts of projections make any sense whatsoever is we need these two numbers to be the same, so that the yield stays the same, so that we don't have this phenomenon of the total return going higher and higher or lower and lower. The total return estimate over the years has to be the same, otherwise it makes no sense. So if we put in a 10.45% for both of them, just kind of do the average of the two, just to, it's a compromise between the two, at least now we have a yield that's consistent and we have a total return that's consistent over the period. But even just by doing that and not accounting for his over optimism, we've already had a massive effect on the retirement of a person. If a person was to use the projection as it was before, they would have expected about 197 grand a year in retirement at year 30. So we can see there, just by having the projection make sense, regardless of its over optimism, even just by doing that, we've completely decimated their retirement income projection. This is why these sorts of projections people do all the time are so dangerous to my mind. If we then get something more sensible, let's go still mega optimistic. This is still mega optimistic, but quite a bit lower. If we do 6 and 6%, that to me is still really high expectations for this fund. But we've gone right down to 31 grand a year in retirement. Yeah, massive effects on the projection. So if anyone's reading, watching that video, seeing those numbers and thinking to themselves and planning their life around 100, I think he projected 185 grand. Yeah, if they're planning their life on 185,000 a year dollars, then they might be in for a shock. Does it mean that there should be some sort of regulation about people like me making YouTube videos when they don't know what they're talking about? I mean, at least I try to say often that I don't know what I'm talking about, and I try to repeat often that you shouldn't do what I do. But people like this talk with confidence, and they do projections with confidence, and they have 111,000 subscribers. It's crazy. And I saw a comment. Well, where was it? I think it was the first comment last time. Here we go. Hallelujah. God is still performing wonders. I'm positioning myself for such miracles. This is the best thing I've seen today on YouTube. Thank you so much. Lots of false optimism being given out there. Although I'm hoping there's a dose of sarcasm in there. I'm hoping they're as sceptical as me and they're being sarcastic there. Although Americans, I remember back in the day people used to say Americans don't get irony or sarcasm. But I think maybe that might have changed over the decades since I remember hearing that. Friends had a bit of irony and sarcasm in there, didn't they? Didn't it? Maybe that changed things. I would just go 4, 4 and 4. That's more like it, as like a realistic projection. But then actually, I mean, if you want to pause the video, you can read this. I wrote all this ages ago, but I remember writing it. And the best way to use this sort of projection is to adjust your returns by your estimate of inflation. So if we estimate inflation to be 3% and our total return to be 8%, like I've got it in here now, that makes a total return of 5%, doesn't it? So if we what would that be then? Would that be 2.5% for each one, mate? Well, the starting yield would be 4%. So to make 5%, you just reduce your dividend growth and your share price growth to 2. So it'd have to go down to 1, wouldn't it? Yeah, so what you've got there is an inflation adjusted projection. So here, you'd be being paid 16,583 in today's money on year 30. because the total return has been reduced by an estimate of 3% for inflation. But you've got to be careful there as well, because what that does is, because all of these numbers are now in today's money, in effect, what that does is it makes these 6,240 contributions, in reality, they'd have to be higher each year by 3% to make this number true. Because if you're putting, in a year's time, putting 6240 into it isn't the same, because this is inflation adjusted. You'd have to put in 6240 at 3%. You'd have to put in 6427 in year 2, and then each year you'd add a bit more by inflation, which to me makes sense, because your income will grow each year, so you should put more money in each year. Oh yeah, and then as coincidence would have it, there was a comment on Reddit as well, and the commenter put a picture of a similar projection about dividends and stuff, and it was using this calculator. I don't remember what their assumptions were, but I'm just going to take the dividend tax off because that complicates matters. But from what I remember, all of the projections were just completely wrong, and it baffled me, because what we've got here is we've got an annual dividend yield of 3% is used as like an input to the calculator, and then it's at least these two numbers are the same. It's having stock price go up by 10%, and it's having the dividend per unit or per share go up by 10% as well. So at least on that front, the default assumptions are okay. But if we recalculate and look at this payment schedule here, 2891.42, and we divide it by, to be honest, I don't know which one to divide it by, but if we divide it by the highest number, just to give it the benefit of the doubt, by year 10, the dividend yield of their portfolio that they're kind of projecting has risen to 6.9%. But we know that that can't be true, because the assumptions we've input into this calculator are dividend rising by 10%, stock price rising by 10%. So how can the dividend yield possibly deviate from the 3% it starts at? If the share price and the dividend grow by the same amount, the dividend yield has to stay the same. So for this calculator, and I've seen another, I remember a couple of years ago I saw another calculator that did all sorts of crazy things that I couldn't work out. I couldn't even work out how they were getting it wrong. So yeah, this is another warning. Don't trust these calculators. Don't bother with them, because the thing is, when you do have a consistent dividend growth and a share price growth, which is the only sensible way of doing it, when you do that, it actually makes the whole thing pointless, because all you need to do is just apply a 5% total return to your pot, and then at the end, whenever you want to project your annual dividend, so if you wanted to project your annual dividend at 30, just increase the money you have in the portfolio by 5% a year, and then just multiply it by 4, because the dividend yield stays at 4% the whole time in this projection. The only sensible way of doing it is to have these two the same number. But then once you do that, there's no point in doing it like this anyway. You might as well just do a total return projection, which is much simpler to work out. I remember doing this the other day as well. We actually stop it from having any contributions. So we're just simplifying this calculation. So what we've got here is an initial amount of 10,000, and we've got no contributions happening. So this makes the calculation even simpler. So when we do that, annual contribution 0, this means that to work out our total return, all we have to do is that number divided by that number. Let's see, what should the total return be? It should be 3% plus 10%. Yeah, that's right, so it should be 13%, which is way too high, of course. Oh no, because it's drips turned off. I'm sorry, yeah, that's wrong. Drips turned off. So actually, for this example, we need to put drip on. So now, the 3% should be added to the return. So now, I'm hoping that at least in the first year, we get a 13% total return. 12,836. Because now it's reinvesting the dividend, but there's no contributions being made. We divide that by 11,300. Nope, that's wrong. It should be 10,000. Sorry, I'm doing the wrong year. Sorry, so 10,000, so it's actually 13. 11,300. Oh yeah, we can see that already, can't we? That's an easy calculation to do in your head. Yeah, so 13% in year one, but that, because we've got consistent numbers here, this total return should be the same every year. And from memory, I think, let's see if I'm remembering this correctly, 41,097.25 divided by 34,910.88. Yeah, there we go. It's projecting a 17.7% return in year 10. So this calculator is completely off in everything it does. Because that, yeah, correct me if I'm wrong, I can't, yeah, it has to be a consistent total return, because the dividend's growing by 10%, the payout's rising by 10%, and the yield starts at 3%, so it should just be 13% every year. Yeah, dividend rises by that much per year, share price gains by 10% a year. So yeah, I mean, it's just crazy that a calculator like this can be out in the wild misleading people. I do not get it. Alright, I'll stop ranting now. I think that's it for the week, isn't it? There's nothing else to say here. Nope, that'll do us. Alright, watch out for those projections. Have fun. Goodbye.